Hello traders, welcome back to the fourth video in our exciting series. I am Sanjay from Tribe International and I am thrilled to continue this journey with you. Tribe Hub, where financial empowerment begins. This session is powered by Tribe Hub, a place for all financial education, an initiative by Tribe to empower traders with knowledge, tools, and community support to excel in the financial markets. Today, we are diving into an essential topic for every trader: risk management in Forex trading. Effective risk management is the cornerstone of successful trading, helping you protect your capital and maximize your profits. So let's get started. Video part 1. In this part, we will cover some basics but very important concept of risk management. First, let's define what we mean by risk management. In Forex trading, risk management involves identifying, analyzing, and mitigating the risk associated with the trading activities. The goal is to protect your trading capital from significant losses while allowing for profitable trades to run. First, let's understand why risk management is crucial. Risk management helps you survive in the market for the long run. It's the foundation of disciplined trading strategies, ensuring you to stay in the game long enough to achieve consistent profits. It protects your trading capital by helping traders minimize their losses, ensuring that a single bad trade does not wipe out their entire trading account. And traders can preserve their trading capital, allowing them to stay in the market longer and take advantage of profitable opportunities as they arise. It also enhances consistency by encouraging traders to stick to their trading plan and avoid impulsive decisions. And traders can achieve more stable and consistent returns, reducing the impact of market volatility on their overall portfolio. It maintains disciplined mindset. How? Let's see. By improving decision making. When traders know their risk is controlled, then traders can make their decisions with a clear and focused mindset, free from the fear of catastrophic losses. Risk management allows trader to analyze the market more objectively, making decisions based on data and strategy rather than the emotions. It maintains emotional control, and that is where all of the personal problem arises. So risk management helps to evaluate proper risk measures, and it reduces the stress and anxiety associated with trading, helps trader maintain emotional control. By setting risk limits, trader can avoid the issue of overtrading and revenge trading, which often leads to significant losses. Forex trading involves various risks that trader needs to manage effectively to avoid significant losses. Here are some of the common risks in Forex trading. First is market risk. The risk of losses due to adverse movement in the currency prices. Any unexpected changes in exchange rates can lead to significant losses. Market risk is influenced by factors such as economic events, political developments, and market sentiments. So we need to aware of those economic events developing in the market. Second is leverage risk. The risk is associated with borrowed fund to increase the size of trading position. While leverage can amplify profits, it can also magnifies losses. You need to understand that leverage is two-edged sword. If it can make your day, then it can also break your day. So you need to be very careful while using leverage. A small adverse price movement can result in substantial losses if high leverage is used in your positions. Third is liquidity risk. The risk that a trader will not be able to buy or sell a currency pair at the desired price due to lack of market participants. Let's say if the volume is very low in any currency, then what will happen? You may not be able to close your position at your desired level, or you may not be able to initiate any position at your desired price. Then the slippage will be very high. So those slippages and not hitting your orders is the risk of liquidity. During periods of low liquidity such as market closing, or low liquidity also occurs in exotic pairs which do not have a lot of participants. So during these times, or in those currency pairs, it may be very challenging to execute your trades at favorable price. That can lead to potential losses. So you need to aware of liquidity, that you are only trading in higher liquidity currency pairs. Then the fourth one is operational risk related to technical or human failures. Any application can glitch, the server can break down, so these are out of our control, and sometimes you also may forget to set your stop loss orders. Okay, so these issues can disrupt trading and lead to unintended losses. So you need to be very careful while trading in the market. The fifth one is psychological risk. The risk arising from traders' emotional reaction and decision making process. There are some factors that can affect your psychological level, or you can say the level of your mindset, the control you have on yourself. Those factors are fear, greed, and stress can also lead to poor trading decisions. Sometimes you may frustrate and do some kind of over trading, or if you are continuously losing, then you might go into a state of mind where you start doing some revenge trading, alright, or you are facing some huge losses in a particular position. Then some people might also abandon those positions on open itself, that they think that okay, whatever will happen, if it becomes hero or zero, I don't care. So those kind of psychological aspects can destruct your trading capital. And the last kind of risk is lack of knowledge risk. Some people start out trading in Forex without having proper knowledge, or without seeking proper study materials, or without using any kind of analysis. They are not using any fundamental or technical aspects. They are just opening their trading platforms and buying if the market is rising and selling if the market is falling. So these kind of actions by traders can impact their trading capital, and they won't be able to survive for the long. So this is where risk management comes into the picture, and it helps you eliminate all of these risks and surf the market consistently. A well-structured trading plan is your blueprint for success. In Forex market, let's explore how you can create and set your trading plan so that you can trade in the Forex market flawlessly. A trading plan helps you stay disciplined, manage risk, and make informed decision. It acts as a roadmap guiding you through the complexities of the Forex market. A comprehensive trading plan consists of several key elements. Let's break them down. First is trading goals. Start by setting clear and realistic objectives. What you are aiming to achieve. It could be a specific percentage return each month or each quarter that you have to decide by yourself by writing it down on the paper. For example, you might set a goal to achieve a 5% return on your trading capital every month, and this is very decent return. If you were able to maintain this 5% consistency each month, then you will be able to generate a whooping 60% return in a year, and in 1.5 years or 2 years you might able to double your capital. All right, so do not underestimate this 5% as a small percentage. If you able to achieve this consistency, then it will gonna do very good in the long run. The second element is risk tolerance. So in your trading plan, you need to understand your risk tolerance. How much of your capital you are willing to risk on a single trade. For example, a common rule is to risk not more than 1 to 2% of your account on any single trade. This practice will helps you protect your trading capital and allows you to take enough trades so that you can test your strategy and maintain a consistent result in the month on month basis or year on year basis. Let's say if you are risking 20% of your trading capital on one single trade, then how many trades you are going to take? Few trades. Only 4 trades you can take if you are risking 20%. Alright, and that is also after if you were able to win 1 or 2 trades out of those 4 trades. Alright, so this is very huge percentage, 20%. So if you, let's say if you are using 1 to 2% of your account on a single trade, if you are using 1%, then you can take 100 trades in a row without worrying. And if the ratio is 50-50, okay, and your risk to reward ratio is good, then also you will be profitable. Alright, so you need to understand and write down what is your risk tolerance. Then you need to understand what is your trading strategy. Outline your trading strategy. It means what will be your entry and exit rules, and those entry and exit rules should not be random. That should be based on thorough analysis and good backtesting results. For example, you might use a moving average crossover strategy. So in the moving average scenario we have discussed in the last video, the moving average averages out the fluctuation. So the market fluctuations are like this, and this is moving average. If you include one more moving average here of different period, then these moving averages give crossovers like this. Shorter average will cross above this longer moving average, then you will initiate a buy trade. So these are the example of your entry and exit rules. Okay, and then you are setting your stop losses below some significant previous swing low, and you are taking your profits at the high of this channel resistance. So these will be your entry and exit rules based on a logical system. When you decide the entry and exit rules, means the strategy you are going to use, then before finalizing the entry exit rules, you need to understand and define your trading style, because every trader uses different types of trading styles and execute trades based on it. So this will be the first and prior practice you need to understand. There are several types of trading styles. We are going to discuss each one of them, and then you can understand which kind of style is suited to you. Then you can select that particular style and then create your entry and exit rules. So the first style is intraday trading. So let's understand what happens in intraday trading. when you buy and sell within the same trading day, it is called intraday. Means within the same day you are closing your positions. You are not carrying anything for the next day. So in this intraday trading, you will be focusing on very short term price movement, and you can also initiate multiple trades, and the holding period in this intraday trading can be from couple of minutes to couple of hours. Like you can buy and sell the particular currency in 5 minutes, or you can even sell it in 1 minute also, or even less than 1 minute, or you can also hold for 4-5 hours, 2 hours. Okay, it will depend on the market condition plus your trading style in intraday. So you can use 5-minute chart, 15-minute chart, or 30-minute chart to execute your trades. Of course, the idea or the logic of that particular trade can come from 1 hour chart or day chart, but these are the time frames that you need to switch on to execute the intraday trading, because this time frames will gonna offer you the best entry price. Alright, then the next one is swing trading. It focuses on very short term to medium term price movement. Sometimes traders try to capture swings in the market. Swing means one particular leg in single direction. Let's say this trend is going on, alright, so you buy this retracement here. At this retracement you bought it in an expectation for the price to move up towards the next swing high. So you buy here and you try to capture this one swing in this up move. So you will take your profit around this level. Okay, so these swings can last around few days to few weeks. So this is where swing trading comes into the picture, where you can initiate your trades. The time frame you are going to use will be 1 hour, 4 hour, or 1 day. On these charts you can find the entry and exits, alright, but the trade logic can come from 1 day, 1 week chart also. So this kind of trading is considered as the safest type of trading for traders starting out. The next is positional trading, where you have a plan for buy and just hold for the long term perspective. Let's say if you have a growth view on USD, then you can buy USD INR pair, okay, and you hold it for 5 years or 2 years or 1 year. So you are betting on the fundamental factors for a longer period of time. This is also the most safest, but it takes very huge time to give you particular target, and you have to use less leverage while holding for long term. Alright, this creates a long term value, and the holding period will be few months to few years. So you have to combine fundamentals also, because without using fundamentals and only using technical analysis will not gonna help you understand the long-term growth of the economy or any currency pair. Alright, so you can use, for technical entries, you can use weekly or monthly charts to identify best price. Then the fastest and the most riskiest type of trading is scalping. These scalpings are ultra short term trades where you buy in huge quantity and sell it in few seconds only, so that you are scratching out little profits out of the market in a very less time. So it is very risky, plus it needs good infrastructure to execute trades that fast, because even one single pip can make a huge impact on your trading capital, because the quantity is very high. Okay, so the holding period is microseconds, means less than 1 second also scalpers hold their trades, and the maximum time will be couple of minutes they can hold. Okay, so they use seconds to 1 minute time frame, or even they can move further to 5 minute time frame only. So these are the four major kind of styles of trading that you can select from. Okay, if you want to trade in intraday, then you have to understand what are its time frame and what kind of strategy that will gonna work. And how you will gonna know? You have to create your plan, then backtest it for some period, then take your real money into the market. Video part 2. Let's decode some advanced terminologies and concept of risk management. In this segment, we are going to discuss two crucial components in forex trading: position sizing and leverage. Position sizing determines how much of your capital you allocate to a particular trade, or in simple terms, this is to determine how much you can buy according to your capital. Proper position sizing helps you control the risk and maximize potential gain while protecting your trading capital. And one more important point to remember in position sizing is that it equals out each and every trade. So your quantity in every trade will gonna be equal. This is how you will gonna achieve a consistent result. Otherwise, what will gonna happen if you take irrational quantities? You are buying 2 lots in the first trade, which has give you a win, but on the second trade you bought 4 lots, and where you got your stop loss hit. Then on the third trade you bought only 1 lot and you had a win in that particular trade. Alright, then again on the fourth trade, what you are doing is you are buying 6 lots here and you win this trade also. On the fifth trade you bought 5 lots, but here you lose it. So what will gonna happen at the end of these 5 trades? Either you are in a loss or in a profit, but there is no consistency. And when you do this type of irrational position sizes, then majority of the time, like 90% of the time, at the end you will gonna be in loss only. There are very few chances that your account will gonna be green after having irrational quantities. It's just a mere luck. Alright, so this is why we need to have a very good plan for position sizing. There is a very simple formula for position sizing is the risk value in terms of dollars or rupees. So let's say if my trading capital is 10,000 and I have made a rule that I will risk not more than 2% of my total capital. So this will gonna be amount to $200. So my risk value will be $200, and trade risk in pips means how much is my stop loss. So let's say my stop loss is 40 pips or something, then I have to just divide 200 by 40. So here I will get per pip stop loss value. Let me explain you with an example. So first you need to follow certain steps. Okay, so first step is you need to identify how much percentage you are willing to risk. Normally people risk only 1 to 2%. Sometimes some aggressive players can risk around 5% on single trade also, if they have very huge confirmation biases. Alright, so with a $10,000 account and 2% risk, it means 200 per trade. Very simple. Then you have to identify the trade risk. Trade risk is the difference between the entry and your stop loss level. Let's say you have bought Euro USD at the rate of 1.1000 with a stop loss at 1.0950. It means we are having a difference of 50 pips. So this 50 pips is my stop loss. Alright, so these stop loss and the account risk I am going to use both of these elements to identify how much quantity I should buy. So with the formula, it's very simple that you just need to divide. Now you got that $4 per pip. Now the big question, if you are trading any stock, then it becomes very easy. This will gonna be the quantity here, but in terms of forex trading you need to identify that per pip value of your lot size. So in case of Euro USD, the standard lot size is 1 lakh units. So the per pip value here will gonna be $10. So of course your risk for per pip in this capital plan, it's not possible to buy a standard lot. So here you can see the mini lot have a pip value of just one single dollar. Alright, so what you can do is you can buy 4 lots of mini contract of Euro USD, and that will gonna sustain in your whole plan. Okay, if the mini lot in any other currency pair is just 5,000 units, alright, then how much quantity you can buy? You can buy 8 lots. Okay, so here you will get the per pip value of your stop loss, and then you need to understand with the help of every currency's lot sizes. Alright, so I hope the position sizing concept has been cleared. Now let's move to leverage. Leverage allows you to control a large position with a relatively small amount of capital. As I have said before, leverage is two-edged sword. If it can make you big money, then it can also make a huge dent on your capital account. Leverage is like a loan provided by your broker. For example, if you use 50:1 leverage, then with every $1 in your account you can buy currency worth of $50. What you are doing is you are controlling 50x of your money. You only have $1, but your broker is giving you another $49 to you. Let's see the benefit and risk. Leverage can significantly increase your profits, but it can also increase your risk, so you have to manage it very carefully. Okay, a 1% move in $50,000 position with 50:1 leverage equals to 500 profit or loss. Then you need to understand that $500 is your risk capacity or it is beyond your risk capacity. As we have discussed in the previous slide in position sizing, that my maximum risk should only be $200 per trade. So I cannot use 50:1 leverage. I need to reduce it. I might want to use 20:1 or even 10:1. Handle leverage very carefully. Let's see how you can use the leverage. So first of all, you have to decide your risk capacity and then evaluate that in that particular risk capacity how much leverage is suitable for you and your risk tolerance, and how much leverage is supported by your trading strategy. And how will you gonna be knowing all this information? By backtesting your strategy. Okay, before starting out with real money, you can just start out in a demo account and practice your trades by tweaking the leverage and position sizing. Then at the end, if you maintain proper records, you have a perfect system that you can use with your real money. The common practice is that a beginner trader should only use 5:1 leverage, or a conservative trader only uses 10:1 leverage to limit your risk in the initial days. Then margin. Margin and leverage are mostly interconnected. Margin is the amount of money that you need to deposit with your broker to open and maintain a leveraged position. Margin is like a collateral or a deposit, security deposit required to use leverage. Leverage is borrowed money. Then you also need to contribute from your side a little bit. So that's why the broker is asking $10 to initiate a particular position. Then only he will give you $100 as a loan to you, so that you have deposited this $10 as a security to get this $100 loan. Risk management with leverage is very important, and how you can do is you can use stop loss orders in place to manage and protect your capital account. Because if you do not use stop losses, then what will gonna happen is you might end up losing all of your capital because you have took a leverage, and leverage can wipe out your account if you are not using proper stop loss and target orders. So there are two types of margin. Initial margin, it is the amount that you need to pay to open a position. Let's say if you want to trade a $100,000 position, then with a leverage of 50:1, okay, then you need to deposit $2,000 minimum to open this position. This will be your minimum deposit required, and this will be called as margin. Okay, the second type of margin is maintenance margin. Let's say if you have deposited this $2,000 initially, then what has happened is on this $100,000 position you are getting a loss of $2,100. Okay, then what will gonna happen? Your broker will gonna ask you for more money because you are already running $100 in minus. If you do not top up that amount with your broker, then there is a risk of automatic close of your position in loss. So this is what maintenance margin means: the minimum amount that must be kept in the account to keep the position open. How do they work together? Leverage and margin. Then if you are losing that particular deposited money, then you will receive a margin call from broker. If your position moves against you and your account balance falls below the maintenance margin level, your broker will issue a margin call and you will need to deposit more funds to maintain the position. Otherwise, it will be closed to prevent further losses. Alright, so this is all about margin. Now let's discuss about stop loss and take profit orders. These are the two tools that you can use to initiate a position and to close out your position in case of profit or in case of loss, and they can protect you from having uncertain losses in situations like high volatile market movements or any big news event day, or you are very much uncertain. So these orders will gonna help you limit your losses and take your profits at certain levels. Stop loss order is a type of order that automatically closes a losing position when the market reaches a specific price level. This will gonna help you limit your losses. For example, if we are buying Euro USD at 1.1000 and if I am setting my stop loss level at 1.0950, it means I am having a 50 pips stop loss. Okay, so what will gonna happen is I can use the stop loss order to limit my loss. If the market crosses below this particular level, then at this price my position will gonna close out automatically and I will only get a loss of 50 points, not further than that. So you can set these pre-orders. Similarly, take profit orders. Take profit or target orders, you can say. Take profit order is a type of order that automatically closes a winning position when the market reaches a specific price level, securing your profits. For example, we bought this Euro USD at 1.000, then want to close if this reaches 1.1100. So I set a pre-order in the market to close my position if the market moves above a particular level. So I will get 100 pips as my profit and the position will no longer gonna be open. Okay, so just open your broker's terminal and check out these two types of orders that you can use and practice it out for few times in dummy account to have a grip on it. This is an example of USD versus Japanese yen on 15-minute chart. So here is our buy price. This was our entry and we can set our target order at our desired level and we can set the stop loss level at the our maximum risk level. Okay, so if the market or moves below this level, then I am out with the stop loss of 160 pips. But if I win or the market moves in my favor, then I can take profit around 400 pips at least. Alright, so you can see in this tool here the risk to reward ratio is also there. 1:2.4 is the risk to reward ratio. If I am risking $1, then I am aiming for $2.4. So this is how you can use in the short position and in the long position also. So you can go to TradingView and find out the position tool. Moving ahead with diversification and hedging. These two are the concept that many trader uses to avoid getting huge losses. Okay, so first we will discuss about diversification. The main goal is to minimize the impact of any single investment's poor performance on your overall portfolio. If you are putting all of your eggs in one single basket and in some accident that basket get hit or get fall down, okay, then you will gonna lose all of your eggs, right? Similarly, if you are investing all of your money in one single currency or you are taking position in only one single currency pair, then there might be a risk that it will gonna get a bit uncertain and it may move against your position. So to avoid that kind of risk, you can go for diversification. It involves spreading your investment across different assets or currency pairs to reduce risk. For example, instead of investing all your capital in one currency pair like Euro USD, you can spread your investment across multiple pairs such as GBP USD, USD JPY and AUD USD. You must need to check that these currencies should not be correlated positively. If they are positively correlated, then your diversification will not have the meaningful impact or it will not gonna fulfill your purpose of diversification. So make sure you check the correlations. So let's see what are the benefits of diversification. It reduces the risk. By holding a variety of assets, you reduce the risk of significant losses from any single trade. Alright, and it also smoother the returns. It means it will give you average returns over a period of time, or you can also consider it as a fixed type of return. Okay, because one currency is rising, one currency is constant, and the third one also rising, and the fourth one is declining, then these three might average out the losses of this one, and still overall you will gonna be in the green only. Means you will have a positive profit and loss in your account. So let's quickly see some practical aspects to diversify your portfolio. You can use multiple currency pairs as we have discussed earlier. You can use minor, major or exotic pairs to spread the risk, or you can include different asset classes, like you can go for gold, silver or other commodities, or you can go for stocks or other indices. Alright, to diversify your risk. Beyond forex market, you can adjust the exposure based on market condition. Like you are monitoring the market condition and adjust your portfolio accordingly. If you are seeing that USD INR starting a downtrend on technical chart, then you might want to book profit in that particular currency pair and may search for different currency pair that is going to move up or going to start a new uptrend. Alright, so this will be according to market conditions. Then moving ahead to hedging. Hedging is a strategy used to protect your investments from adverse price movement by taking an offsetting position. For example, you have a long position in Euro USD, then you might take a short position in GBP USD to hedge against unfavorable movements in the market. So one currency is rising and you are selling this currency. So what will gonna happen is you will gonna either be making money on the differences or losing money on the differences of the price movement, but you will not gonna have a huge impact. A one directional impact will not gonna be there. There are some benefits of hedging. First is risk mitigation. It helps you to mitigate risk by offsetting potential losses by due to directional basis. If the market moves against your primary position, the hedge can compensate for some or all of the losses that you are getting on the primary position. Alright, and in times of volatile market, hedging provides stability and allow you to maintain your trading strategy despite rapid market fluctuations. If you know that there is very much uncertainty on directional basis or the direction of the market is not clear, then you want to start using some hedging strategies there. Otherwise, in volatility, your stop losses and will gonna get hit too often, and that's not good for a consistent result. So you need to be a bit dynamic and change your strategies according to the market conditions. There are some kinds of hedging that you can use. There is direct hedging. Direct hedging involves opening a position opposite to your existing trade in the same currency pair. If I am long in USD INR, then in any other account I might want to short USD INR to hedge for the particular period. I have a long position and some loss is running on this one. Then if I am shorting the same currency on any different account, then this will gonna be in profit. So this profit will gonna compensate a little bit for the loss of this primary position. This is how this direct hedging is done. Then there is a currency correlation hedging. How currency correlation is done? You can identify and use correlated pairs to hedge your position. Let's say if USD JPY and USD AUD are positively correlated, then what you can do is you can go long in this one and you can go short in this one. This is how correlation hedging works. And to know more about correlations, you have to watch the second video that we have covered on currency pair analysis. And the third type of hedging is options. You can purchase put or call options to hedge against potential losses. For example, buy a put option on Euro USD if you are concerned about potential downside risk. Managing your emotions and maintaining discipline are crucial for long-term success. That's why you need to understand and remember the psychological aspects of risk management. Emotional control is vital in trading because emotions like fear and greed can lead to poor decision making. Fear can cause you to exit trades prematurely or avoid taking trades altogether, while greed can lead to overtrading and taking excessive risks. For example, imagine closing a profitable trade too early because of fear of loss, missing out on potential gains. The impact of decision making. Emotional trading often leads to impulsive decisions that deviate from your trading plan, and you might end up doing something which is not you have planned before. For example, you are entering a trade without proper technical analysis due to the fear of missing out can result in huge losses. To avoid these kind of problems, you have to develop a emotional discipline. It involves creating a trading plan and managing your risk according to that particular plan. For example, setting clear entry and exit rules, risk management strategies, and sticking to them is the most important factor here. Then you need to practice all of these strategies and follow your plan every time. Patience is the key in trading. Wait for the right setup and don't rush into the trade. Take entries only when your setup is forming in the market. By establishing routine and consistency, you can approach the market rationally, and it will also helps you control the emotion. Like you can review the market every day and follow step by step process to analyze the market. Like what we do in technical analysis is top down analysis. We start by understanding the index, industry, and then go to stock. Alright, this is how you can step by step plan your research. And to maintain a desired emotional control, you need to avoid some common psychological problems, and one of them is overtrading. Overtrading is driven by the desire to make quick profit. It can lead to significant losses. So what you can do is you can set a limit on the number of trades you are going to take each week. Then revenge trading is the enemy of trading. Alright, revenge trading occurs when you try to recover losses by taking excessive risk or fighting the market is we call revenge trading. If your setup is not forming and then you are directly jumping into trades, or you are not accepting the losses that you have planned. So what you have to do is you have to avoid revenge trading also. Then you have to take confirmations as much as you can. Technical confirmations you can take fundamental confirmations. You can combine both of them and stay objective and consider all available informations before making any decision. In this way, you can avoid all of these common psychological pitfalls and make a rational trading decision. In the last, you need to be aware of good risk management tools and platforms. And what platforms you can use are, you need to have a very good broker initially to execute your trades, and you need a charting platform where you are going to do all of your research and then plan your trades there. And similarly, a good platform to backtest all of your strategies and create a proper structure to execute your trades. And in addition to these platforms, you need a good pips calculator. You need a position sizing tool. Alright, you cannot do all of those calculations manually, because in live market you won't have that much time to take up your calculator and do all of the calculations manually. So you need good platforms for calculating the size of the pips and to calculate the position sizing, and also need a fundamental calendar that will gonna help you be updated on the major market events. So this is all for today's video. Make sure to subscribe to our community channels to stay updated. Thanks for sticking around. If you found this video helpful, there is plenty more to come in our series on Forex and technical analysis. And don't forget, for all your trading needs, visit tribe.com. For more in-depth trading education, head over to tribehub.com. Thanks for watching, happy trading, and I'll see you in the next video.